There are many ways to determine whether this stock or this sector is the place to invest. The point is here, however we make that decision, if we're coming down on favoring ABC versus XYZ, we're an active manager, an active investor. We clearly don't believe that markets are perfectly efficient. That's why we're trying to spot buying and selling opportunities. If we believe the market is perfectly efficient or close enough, instead of picking individual stocks or bonds or even industry sectors, we can use index funds. I want to be in the S&P 500 or the small cap index, but I don't want to have to try to pick different companies, their stocks or their bonds. So no matter how we get there, what kind of analysis we use, if we're picking stocks, we're active, and if we're just basing things on whether it's growth or value or large cap, and then I just want to have low cost indexes, that's a passive approach. A growth stock, as it says here, is expensive. Now we don't mean whether it's $1,000 a share or $30 a share. We mean compared to the book value or the earnings, the market price is very high. It also, if it's a growth stock, probably is not associated with any dividends or not a large dividend. So if I'm a growth investor, I need a long time horizon. I'm going to buy stocks that hopefully go way up in value over time, but they're volatile prices along the way. For 3 years, I could be very depressed that I ever bought ABC, and then 7 years later, maybe I've doubled my money, or not. A value stock, it's a value price for different reasons. It could just be this company made a mistake, or it's in an industry that just doesn't support a big price to earnings or price to book ratio, or in the year 2000, anything with a .com in its name was huge, and then a few years later nobody wanted to touch it. Whatever it is, these stocks are trading at a low valuation. So my analogy here is if you want to buy a really nice property that's brand new and you hope it keeps going up, that's a growth approach. If you want to buy a fixer-upper, that's really a value approach. So this company's not doing well now, or the sector's not doing that well, but I think I can buy it cheap and then things are going to turn around. That's a value investor. If you buy a large cap value stock, you tend to get a nice dividend yield because the dividend typically doesn't change, but if you can buy that dividend, so to speak, at a lower price, you're getting a higher yield. So if you're an investor, what are you looking for? It really depends on what's your life cycle? What are your goals? You want to go back to college in 20 years? That's a long time horizon. You might want to save up some money and hopefully it'll grow over time. Is that called growth or capital appreciation? Either way. But you need a long time horizon because year by year or quarter by quarter, it can get really scary. If you just look at the historical returns of the stock market, it's anybody's guess what's going to happen in any given year. But over 10 or 20 years, the data shows pretty much stocks are a great place to be. Capital appreciation. I'm not looking for income. I'll take the dividends if they pay them, but that's not why I bought the stock. If I'm an income investor, my first choice would be bonds. Bond interest has to be paid or that company is pretty much done. Preferred stock is my next choice. It's not likely they're going to cut the dividend or reduce it, but they could. So it's still a good income investment. There's really no growth attached to preferred stock. But the income itself is not as dependable as bond interest. There are real estate investment trusts, which are common stocks that pay a really high dividend yield. And then just randomly, there are certain companies that happen to pay a really nice dividend. Like I said, Microsoft is very generous. Whatever their profits are, they tend to pay a third of that out as a dividend. And if, as an income investor, you're in products that are really just priced compared to interest rates and perceived safety, it's not every day another headline comes out and that could make the stock go up or down 20%. No, I'm not in common stock. I'm in bonds and preferred stock. So day to day, year by year, I don't see a lot of big price swings. And I'm really just focused on the steady income I can get. Instead of picking stocks and bonds, many investors just allocate their assets to different asset classes. I'll put this percentage in equity, this percentage in fixed income, this percentage in cash, and then over here I have a real estate portfolio which I like to group together when I meet with my financial planner. If you're in equities, you can then subdivide among small cap, which is more aggressive, than mid cap, which is more aggressive than large cap. So if I want to be in the stock market but somewhat conservative, I'll put a large percentage in there, large cap stock. If I'm opening up an IRA at age 29, it might all be small cap stocks. and then again, how much should go towards growth and how much towards value. So a lot of people just like percentages. As they get older, they tend to make things more conservative. When their kid is 2 years old, they really should be almost all looking for growth through like small cap and mid cap companies. But then the kid's 17, it's time to put most of the percentages into fixed income and cash, so we can start in a year or so paying some of these tuition bills from the account. When we're allocating, by far the most common is strategic asset allocation. That's what I was hinting at there. My daughter is 2, so it's 90% growth, 10% fixed income. Now my daughter is 17, it might be only 10% growth, 70% fixed income, and the rest in cash. So it's only based on the changing needs of the investor. Tactical would be more like a hedge fund, active management. The portfolio manager is overweighting small cap growth stocks in the technology sector because he or she or they think that's what they should do. So that's whatever you're doing, you still probably need to diversify. You're a growth investor, but you're not only in the telecommunications industry. You want to diversify. You don't want to all be small cap or large cap. If you're a bond investor, even if you're conservative, it doesn't mean you have to be 100% investment grade. Maybe 70% investment grade and 30% junk. Trying to, spread out your risk, but also get the best return you can for the level of risk you're willing to take. Some people like to do sector rotating, but the problem there is you're really doing market timing. Why do you think this year telecommunications will be better than pharmaceutical or energy? If you do, you may want to rotate sectors. The economy is about to recover. These cyclical stocks like steel and heavy equipment, I think they're about to recover. No matter what you're buying, the smart thing is not to put all your money in one stock with one purchase. Rather, I like these 5 mutual funds. I put my money in every month, and it just buys as many shares as that money can buy based on the share price. I also avoid timing risk, meaning I don't pay the all-time high share price over the last 10 years. I'm just putting money in little by little, so I get a lower average cost as opposed to if I bought 100 shares at whatever price. And then active trading is very tough, especially for small investors. They're usually going to come out ahead with a buy and hold approach. Doesn't mean that every stock they hold is going to recover or go up, but market timing is so hard to do. And we have a lot of statistics showing that if you just were in the overall market for 10 years and sat still, you would have done a lot better.